The modern stock market, valued at trillions of dollars, has surged in accessibility thanks to technology. Platforms like Robinhood and Acorns make it so easy that anyone with a smartphone can buy shares with just a tap. The narrative goes that this democratization of investing is giving everyone a slice of the wealth-building pie. The constant stream of market data, price alerts, and hype surrounding the next big stock has created a culture where we're encouraged to check our portfolios daily. Statistics show that about 62% of Americans now have some exposure to the stock market, whether through direct investments, retirement accounts, or mutual funds. On the surface, it sounds like we're all playing the game, all benefiting from the supposed steady growth of the market. But here's the twist. That image of democratized investing is largely an illusion. While more people may own stocks today, the wealth is not equally distributed. The vast majority of individual stock value is controlled by a small percentage of wealthy individuals and institutions, with the richest 10% of Americans owning around 89% of all stocks. For the average retail investor, the idea of ownership often translates to a fraction of a share and little control over how that company operates. They want you to think you're an investor because believing that keeps you engaged, spending on fees, and ultimately fueling the market machine. But at the end of the day, while you're concerned with tiny price fluctuations, you're not really steering the ship. You just think you are. Today, the US stock market is a colossal giant, valued at over $58 trillion, and more than 3 times what it was just a decade ago. It's no longer just Wall Street's playground. With a few taps on a smartphone, everyday Americans can join the world of stocks. And as the second largest asset class globally, second only to Chinese real estate, it's not hard to see why so many are captivated. After all, what could be more empowering than becoming an investor, right? This idea, the notion that regular people can build serious wealth by buying into stocks, has taken on a life of its own. Investment apps and zero-commission trading platforms have made it easier than ever to buy a share here and a fraction of a stock there. But as this supposed revolution sweeps across the nation, it begs the question, is the dream of stock market wealth actually attainable for most Americans? Or is it just another illusion? Sure, more Americans are buying stocks now, but a closer look reveals something unsettling. While the rate of stock ownership is technically increasing, the actual picture is far less glamorous than headlines suggest. According to a Gallup survey, only about 61% of households hold any stock at all, whether directly or indirectly through retirement accounts or mutual funds. That's far from universal, and it's still below the stock ownership levels before the 2008 market crash. Most of these stocks, though, aren't held in private accounts or actively managed portfolios. They're sitting in retirement accounts like 401ks, and they're there mostly because traditional pensions are disappearing. Decades ago, companies offered secure pension plans, providing employees with steady retirement income managed by professionals. Today, those pensions are nearly extinct, and the risk is passed on to workers themselves, who are now left to navigate the unpredictable waters of the stock market to secure their futures. With retirement riding on stock market performance, employees are left with a bittersweet situation. Yes, they're invested in the market, but not by choice, and often not in ways that give them any real control or substantial wealth building potential. This shift has led to the illusion that more people than ever are owning stocks. But in reality, what's happening is more of a structural change in retirement funding rather than a sudden surge in personal investing. Enter apps like Robinhood, which have made it easier than ever to buy stocks, offering zero-commission trading and low barriers to entry. The simplicity and gamification of the process is appealing, especially to younger generations. But while the idea of investing with a swipe is exciting, it's often misleading. According to Robinhood's own filings, the average user account holds less than $5,000. That's hardly a fortune, and certainly not the kind of wealth that will carry someone through retirement or fund major life goals. Why are so many drawn to investing apps then? For a surprising number, it's not about wealth building at all. It's about trying to escape the debt trap. Studies reveal that debt relief is a primary motivator for many users of these platforms. The hope is that the stock market can offer a shortcut out of financial struggles. But with interest payments on high-cost consumer credit often outpacing any likely investment returns, most would be better off directing that money to pay down debt instead. It's a harsh reality that, for the average person, the math simply doesn't add up. And here's the kicker. For some, investing has become less about financial planning and more akin to gambling. There's a reason why the drop in active Robinhood users seems to align with the spike in sports betting apps like DraftKings and FanDuel. It turns out, for many, the stock market and sports betting aren't all that different. Both offer a chance to win big, both are heavily driven by short-term thinking, and both cater to the thrill of risk-taking. The line between investing and gambling can get blurry, and unfortunately, many are drawn to the stock market not to build a nest egg, but to try their luck. Now let's address the so-called serious investors, those who consider themselves methodical, strategic, and in it for the long haul. But here's a sobering fact. The stock market's wealth is held by a concentrated elite. The top 10% of Americans control a staggering 93% of all US stocks, with even more concentrated ownership at the very top, among the wealthiest 0.1%. This means that for most Americans, stock ownership doesn't represent a serious chance to amass wealth. Instead, they're competing for scraps at a table where the wealthiest have already taken most of the pie. If you think about the truly wealthy, the people who earn significant income from dividends and capital gains, very few of them got there by simply investing wisely. For the ultra-wealthy, stock ownership is just one piece of a broader wealth strategy that often includes high-paying careers, lucrative businesses, and sometimes a healthy dose of inheritance. In other words, they weren't investors in the traditional sense. The idea that a middle-class worker can achieve the same kind of success simply by investing in stocks is more myth than reality. Consider this. Even millionaires don't always become wealthy from stocks alone. There's a common misconception that the path to wealth involves diversifying income streams through investments. But studies show that most millionaires aren't rich because they hold stocks. They hold stocks because they are already rich. A well-known IRS study from a few decades ago found that wealthy households typically reported income from multiple sources: dividends, rental income, royalties, and business profits. However, these sources of income required wealth to begin with. They didn't get rich by diversifying. They diversified because they were rich. So where does this leave the average person? Should they give up on investing altogether? Not at all. Investing still has its benefits, but it's no magic bullet. For most people, it's far more impactful to focus on increasing income and controlling debt than to hope for windfall gains in the stock market. The idea of becoming rich through investing alone is largely a pipe dream. And the irony is that people who obsess over their portfolios often end up making worse decisions. Studies have shown that investors who constantly trade and adjust their portfolios generally see lower returns than those who adopt a simple buy and hold strategy. For instance, one study by UC Berkeley found that portfolios held by female investors tended to outperform those of male investors by about 1% annually, largely because women were less likely to engage in frequent speculative trading. So here's the bottom line. For most people, the stock market is a tool, not a solution. The fantasy that anyone can become rich by investing in stocks is misleading at best, dangerous at worst. True wealth building is a long, steady process that typically requires more than a Robinhood account and a few stocks. If you're serious about building wealth, the first step is understanding the reality of investing. It's not glamorous, it's not fast, and it's not going to make you a millionaire overnight. But done right, investing can be a valuable part of a balanced financial plan, one that focuses on stability, debt management, and income growth first. So while the allure of the stock market is strong, remember, it's just one piece of the puzzle, and for most, it's far from the whole picture. So, are you an investor? Maybe, but for the majority of people out there, focusing on your earnings potential and managing your debt will be far more impactful than watching the stock ticker every day. Investing as a tool, but building wealth? That's a whole different story.